Welcome to the Deep Dive. Today we're really digging into Netgear, ticker NTGR, specifically their Q3 2025 earnings call from October 29th.
Yeah, and this one's important. Netgear is, right in the thick of this big strategic change. Q3 was supposed to be that moment, the validation point for their shift to high margin stuff, enterprise, recurring revenue. But the result, it's interesting. Execution looked great, flawless even.
Flawless, right. But the market
Barely blinked. Which tells you investors are already looking ahead. Focus on the risks, not just the Q3 win.
Okay, let's lay out those Q3 numbers first, the non-GAAP ones, because they really were strong, operationally speaking. I mean, they absolutely crushed consensus. Non-GAAP EPS came in at 12 cents.
Right, 12 cents profit. And the street was expecting a loss, right? Like negative 9 cents.
Exactly, a huge swing. And revenue, too, $184.6 million. That beat the high end of their own guidance, let alone the consensus around $172.5 million.
And it's not a one-off. You got to stress the consistency here. This makes it, the sixth quarter in a row they've beaten guidance, both revenue and non-GAAP operating margins.
6 straight quarters. So they're executing?
They are executing. And the biggest proof point, the real operational win, was that record non-GAAP gross margin. Hit 39.6%.
Nearly 40% gross margin. That's huge for them.
Which brings us right back to that puzzle, the conflict here. Math of beats, record margin, and the stock barely nudged, less than 1% up the next day.
Yeah.
Why? You'd think hitting numbers like that, especially that margin, would get a much bigger reaction.
It really signals that the market had already priced in that Q3 performance. And the guidance they gave right after, it just poured cold water on things, created this immediate risk focus. It's that classic problem, right? Reward the past achievement or worry about the known future problem.
And the worry won out this time.
Seems like it. The headwind definitely won. Okay, let's unpack that margin story first, because 39.6% non-GAAP, an all-time high, that really shows the strategy working. You said it was mostly product mix and operational discipline.
Primarily, yes. Shifting towards those higher-end devices. And get this, the enterprise segment, on its own, delivered an all-time high gross margin too. Over 50%.
50% gross margin in enterprise, wow.
Yeah, that shows real pricing power. They've carved out a profitable niche there. That part of the business looks incredibly healthy.
So if enterprise is over 50%, but the whole company is just under 40%, that means the consumer side must still be pulling things down quite a bit.
It is. That's the tale of two Netgears we often talk about. Consumer is definitely a drag on overall profitability. But the growth engine, enterprise, is doing the heavy lifting now. Overall sequential revenue growth was 8.2%.
Okay.
But within enterprise, managed switch revenue, that's their big ProAV, professional audio video focus, they grew 16% just from Q2 to Q3.
16% sequentially in ProAV.
Yeah, strong ASPs, strong unit growth. And they hit 500 AV partners this quarter too. That ecosystem is expanding, feeding that high margin business.
Right, building the moat there. And the other piece of the strategy, recurring revenue, making it sticky.
Exactly. ARR, annual recurring revenue, up 17.2% year over year. It hit $37.9 million. That's driven by things like Armor Plus security subscriptions, higher ASP offerings. They've got 560,000 recurring subscribers now.
And for investors, that ARR metric is key because it lets you start thinking about SaaS multiples, right? Moving beyond just selling hardware boxes.
Precisely. It validates that strategic shift in valuation terms, potentially.
Okay, so operationally strong, ARR growing. What about the structure? Management talked about some changes there.
Yeah, they're cleaning things up to support this focus. The commercial arm is rebranding to Netgear Enterprise. And starting Q4, they'll report in just 2 segments, enterprise and consumer. Makes it clearer.
Simpler to track.
And they're integrating mobile products across both platforms now. So cloud management for enterprise or a single app and subscription for consumer. It's more horizontal.
Makes sense. And this all supports the big differentiator in enterprise, which seems to be security now.
Absolutely. It's all about security, specifically the Exium acquisition integration. That brings SASE's capabilities.
SASE Secure Access Service Edge.
Right. Basically, cloud-managed security firewall, VPN, web filtering designed for SMEs, small to medium businesses, and the MSPs, the managed service providers who serve them.
And they're pitching this as, the only all-in-one SASE and hybrid firewall platform really built for that SMSP market?
That's the positioning. Highly differentiated. And you saw those big deal wins they mentioned.
Yeah, those were eye-catching. A Fortune 10 retailer, Boeing, the South African parliament.
Definitely big names. Huge endorsements. Signals a shift in trust, perception. The question is, how material are they to the bottom line right now? Management says they're closing significant deals.
Suggests monetization is starting.
It does. But the real sustained impact on ARR and revenue, we'll see that play out over the next few quarters. It's clear they're getting meetings they couldn't before, though.
And speaking of confidence, management's putting money where their mouth is with buybacks.
Yep, $20 million worth of stock repurchased, about 815,000 shares, average price around $24.55. That signals belief in the value, offsetting dilution. Standard stuff, but good to see.
Okay, so that internal confidence, the strong Q3 execution, it contrasts sharply with that market reaction and the Q4 guidance. Let's pivot to that headwind.
Right. This is the crux of the muted stock reaction. Management guided to a major gross margin hit in Q4, around 150 basis points.
Oof, 1.5 percentage points off that record margin. That's significant. And the cause?
It's all about DDR4 memory costs, the older memory standard. Major suppliers are basically getting out of the DDR4 market.
Creating a shortage.
Exactly. Driving up spot prices. It hits everyone. But Netgear said it's felt more acutely in the home networking segment.
The lower margin consumer side again.
Right. So it's a supply chain shock, not really an operational misstep on their part. But combine that cost pressure with their ongoing investment in R&D, especially enterprise software, insourcing capabilities.
And the Q4 margin forecast takes a nosedive?
Yeah, non-GAAP operating margin expected between negative 2.0% and positive 1.0%, a big drop from Q3.
Okay. And what about Q4 revenue guidance?
Range of $170 million to $185 million. They also mentioned supply constraints on managed switches are still biting a bit in Q4, limiting the upside.
But they expect that to clear up soon.
They said they expect to get back to a healthy supply position, basically having safety stock again by Q1 2026. So relief is expected early next year.
Interesting timing. Now, there was another factor they highlighted, sort of a macro tailwind.
Yes, and this could be the really interesting counter-narrative to the Q4 gloom. Management specifically mentioned gaining recognition as a U.S.-based public company trusted partner. And that's directly winning them deals.
So this ties into the geopolitical situation. The increased scrutiny on some competitors, particularly Chinese firms like TP-Link.
Exactly. You've got the NDAA rules, FCC actions, state investigations. It's creating a real advantage for Netgear in certain bids. Customers, especially larger enterprises or government-related ones, might be actively choosing Netgear because they're a U.S. company, seen as less risky.
So they're benefiting from sort of competitive risk, geopolitical risk premium working in their favor.
Potentially, yes. This could be more than just a few extra contracts. It could fundamentally change their competitive positioning and growth outlook in enterprise long term. If you're a big company in the West, choosing a U.S. supplier over one facing potential bans becomes a much easier decision.
That really shifts the focus towards 2026 then, especially given the stock's huge run recently. I mean, up almost 50% in 3 months, versus the S&P just over 8%. Expectations are high now.
Very high. And investors looking at 2026 have to weigh that potential geopolitical boost against, typical Q1 seasonality on the consumer side.
Which usually sees a mid-teen percentage drop sequentially for consumer.
Typically, yeah. Plus, they need confirmation that the DDR4 cost issue really does get resolved by then.
So the picture is clear structural improvements, record margins, SaaS coming online, ARR growing nicely.
But facing this very specific, known, near-term margin hit in Q4 from memory costs.
And the stock's run-up leaves absolutely zero room for error. High implied volatility around Q4, clearly.
Which naturally leads us to
our This Is Not Financial Advice segment, the outrageous but plausible trade idea.
Given that setup, high IV around Q4, but longer-term conviction.
You could structure something like a calendarized hedge and bet. The idea is to play that volatility difference between Q4 and further out.
Right. So you look at that high premium, that fear baked into Q4 options, and you sell it. Specifically, maybe sell an out-of-the-money NTGR put spread expiring after the Q4 results, say, late 2025. You collect premium tied to that margin fear.
Okay, so you're harvesting the Q4 worry premium, and then
you take those proceeds, the cash you collected, and use it to fund a longer-term bullish bet. Buy some longer-dated NTGR calls, maybe expiring Q3 2026. Gives you runway for the story to play out.
So the trade structure hedges the known Q4 dip risk using the elevated premium, while placing a leveraged bet that by mid-2026, the supply issues are gone, ProAV keeps growing, and the SASE platform starts showing real monetization.
It's betting on the 2026 turnaround, using the Q4 fear to help finance it. A classic calendar spread concept applied here.
And of course, we have to say, this is just exploring the dynamics from the call, definitely not financial advice.
Absolutely not. Purely illustrative of the tensions in the stock right now.
Okay, let's wrap this up. Key takeaways. Netgear smashed Q3 estimates driven by that strong enterprise mix and record gross margins.
But that got overshadowed immediately by the guidance for a Q4 margin hit, thanks to those DDR4 memory costs hitting the consumer side hardest.
Still, the long-term strategy seems intact and powerful. The ProAV focus, the new SASE platform for secure SMB networking.
And potentially boosted by that geopolitical tailwind, winning deals as a trusted U.S. partner.
So the final thought for you to chew on.
Will that momentum, the big enterprise wins, potentially accelerated by geopolitics, be strong enough and monetized fast enough to offset this near-term margin pain? And looking further out, what kind of sustained ARR growth does Netgear need to actually deliver to justify the valuation bump it's already seen and maybe earn a few of the re-rating into 2026? That's the big question now.
That is the multi-million-dollar question. Excellent analysis. Thanks for joining us for this deep dive on NTGR. We'll catch you on the next one.